46 million ounces in a month when nothing is supposed to happen. January, the quiet month, no pressure, no stress, no headlines, yet the numbers flash on institutional screens. Vault inventories begin to thin, and delivery requests surge to 5 times the norm. This is not speculation. This is not retail excitement. This is physical metal being pulled, deliberately, quietly. While most markets trade promises, someone is asking for the real thing. Bars, weight, custody, possession. March is approaching, affirming the primary delivery month, and suddenly the math no longer works. When an exchange built on confidence faces a demand it cannot satisfy. History suggests the adjustment is never gentle, because once the metal leaves, it does not come back. And what follows is never announced in advance. Welcome to the Boring Currency Index. If you still believe markets should honor what they promise, if you remember a time when delivery meant delivery, then this channel was built for you. Subscribe. Not out of habit, but so you understand what's coming before it forces its way into the headlines, and tell us, where are you watching from today? They first noticed it because it did not fit the calendar. January is not supposed to be important in the silver market. For decades, it has been a quiet month. Contracts roll slowly, warehouses stabilize, large industrial buyers wait for March, May, or July to secure supply. January exists as a pause between cycles, not a moment of stress. That is why the number caused hesitation. In January 2026, requests for physical silver delivery reached 46 million ounces. Analysts who track delivery data every month immediately understood the problem. This was not slightly above average. It was not a seasonal shift. It was 5 times the normal January volume. A deviation this large in the calmest month of the year does not happen by accident. They began checking historical records. Over the previous 5 years, January delivery requests averaged around 9 million ounces. Sometimes 8, sometimes 10. The variation was small and predictable. This consistency was part of what made the futures system reliable. January was boring. That boredom was a feature, not a flaw. But 46 million ounces was not boring. At prevailing prices, the request represented more than $5 billion of physical silver. More importantly, it represented roughly 1% of global annual mine supply, demanded in a single month when industrial demand is usually muted. That alone raised concerns. But what mattered even more was how those contracts were closed. In futures markets, most contracts never result in delivery. They settle in cash. Price exposure is exchanged, not metal. This structure allows massive volumes of paper trading to occur with minimal physical movement. The system assumes that participants prefer liquidity over possession. January 2026 challenged that assumption. Thousands of contracts did not close with cash. They stood for delivery. That choice carries costs: storage fees, insurance, transport, security. No rational institution chooses those costs unless possession itself has become valuable. This was the key signal. The requests were not coming from one actor. They were spread across banks, funds, and industrial firms, different strategies, different geographies. Same conclusion. They wanted the metal, not the promise of metal. For analysts, the timing mattered as much as the size. If such demand appeared in March, it would be noteworthy but explainable. Appearing in January, it suggested something deeper, a shift in behavior, a reassessment of risk. They understood that markets often fail quietly before they fail publicly. Stress appears first in places where it should not exist. January was one of those places, and once that realization set in, the question stopped being, why did this happen? The question became, what happens next? To understand why January's numbers mattered, they had to look inside the system itself. The COMEX silver market was not designed to move metal at scale. It was designed to price metal. Futures contracts exist mainly so businesses can manage risk and discover prices. For decades, this worked because almost everyone chose cash settlement. The metal stayed mostly where it was. This created an invisible balance. On one side were millions of paper contracts traded daily. On the other side was a much smaller pool of physical silver stored in approved warehouses. The system functioned because the two sides rarely collided. Paper claims circled endlessly, while physical metal moved slowly and predictably. But this balance depended on a belief. The belief was that most participants would never ask for delivery. COMEX warehouses hold silver in 2 forms, eligible and registered. Eligible silver belongs to someone but is not promised to the exchange. Registered silver is different. It is specifically marked as available to satisfy delivery requests. Only registered silver can fulfill futures obligations. This distinction is critical. Registered inventory is the exchange's foundation. It is the metal that makes delivery possible. When a contract holder stands for delivery, registered inventory is reduced. Once delivered, that silver is no longer available to back future contracts unless someone chooses to re-register it. For years, this was not a problem. Delivery requests were small, Inventory declined slowly. New metal entered the system. January deliveries barely made a dent. The numbers stayed within safe ranges, and confidence remained intact. But January 2026 changed the math. 46 million ounces were requested against a registered inventory that was already declining. That meant roughly 1/5 of all deliverable silver was spoken for in a single, normally quiet month. No stress test model had planned for that. What made analysts uneasy was not just the withdrawal, it was the direction of movement. Much of the metal was leaving the exchange system entirely. Some was shipped overseas, some was moved into private custody. Once removed, it was unlikely to return. The system does have flexibility. Eligible silver can be converted to registered. New supply can arrive, but none of this is instant. Every step requires time, consent, verification, and logistics. The exchange cannot create silver. It can only manage what exists. For decades, this limitation was theoretical. Now it was visible. They began to see that COMEX was not failing. It was functioning exactly as designed. The problem was that the design assumed demand would remain moderate and predictable. January proved that assumption was no longer reliable. And when assumptions weaken, systems do not collapse immediately. They begin to strain. At this stage, the discussion moved beyond markets and into physics. Silver is not a digital asset. It cannot be created by policy, delayed by negotiation, or transferred with an entry on a screen. Every ounce must be mined, refined, transported, verified, and stored. Each of those steps takes time. Each has limits. Financial markets adjust in seconds. Physical systems do not. This mismatch became the central issue. When demand rises in most markets, price sends a signal. Higher prices attract supply. Producers respond. Balance is restored. That logic works well for services, capital, and software. It works poorly for metals, pulled from the earth. Mining output is slow by design. New projects take years to permit, finance, and build. Existing mines cannot simply double production. Ore grades decline, equipment wears down, labor and energy costs rise. Even when prices move sharply, supply responds with a delay measured in quarters or years. Refining introduces another constraint. Silver does not leave the mine ready for use. It must be processed to precise specifications. Refinery capacity is fixed in the short term. Expanding it requires capital, approvals, and skilled labor. None of that appears overnight. Then comes transportation. A single standard silver bar weighs roughly 70 pounds. Tens of millions of ounces translate into thousands of tons of metal. Moving that volume requires trucks, security, scheduling, and insurance. Each transfer adds friction. Each delay compounds risk. These realities matter because physical silver was not just being requested, it was being removed. Some delivery recipients left the metal in exchange warehouses, others did not. They moved it into private vaults or shipped it to financial centers outside the system. Once relocated, that silver no longer supported futures contracts. It became inventory for someone else's balance sheet. Price could not reverse that flow. Even if silver rose sharply, the metal already delivered would not return unless owners chose to sell. Many did not. They valued certainty over flexibility. This is where the market's expectations collided with reality. The futures system assumes that metal circulates, that it flows in and out as needed. But physical constraints do not behave like capital. They resist speed. They resist compression. They reveal bottlenecks only after pressure builds. By late January, analysts were no longer asking whether supply could keep up. They were asking whether the market had underestimated how slow reality moves. And if that was true, the price was no longer the most important variable. Time was. By the time the physical constraints became visible, the most important shift had already occurred. It was not in price, it was in behavior. Large institutions do not move quickly, and they do not move emotionally. Every decision passes through risk committees, legal teams, and long-range planning models. When these entities change course, it is rarely accidental. In January 2026, that change was clear. Banks that normally rolled contracts forward chose delivery instead. Investment funds accepted storage costs they once avoided. Industrial firms secured months of inventory instead of relying on just-in-time supply. These choices reduced efficiency but increased certainty. That trade-off only makes sense when confidence begins to weaken. They were not reacting to headlines. They were reacting to exposure. For industrial buyers, the risk was operational. Silver is not optional in many manufacturing processes. There is no substitute for its conductivity in high-efficiency electronics, solar cells, and medical equipment. A supply interruption would not slow production. It would stop it. The cost of holding inventory became smaller than the cost of downtime. For financial institutions, the risk was structural. Futures contracts are promises. They work as long as delivery remains theoretical. When delivery becomes common, the promise must be tested. Some institutions preferred to test it early, while metal was still available rather than later under stress. There was also a jurisdictional concern. Once metal is delivered, ownership becomes clear. Bars can be moved to vaults in different countries, under different legal systems. That flexibility disappears when positions remain on paper. History has shown that rules change fastest during crises, not before them. These decisions did not make headlines, but they carried weight. Markets often fail gradually, then suddenly. Before visible breakdowns, there's a quiet phase where informed participants reposition. They accept higher costs, lower returns, and operational inconvenience in exchange for security. That phase was underway. Analysts began to notice a pattern. Physical silver outside the exchange was trading at a premium. Delivery times lengthened. Inventory data moved in one direction. None of this required panic to matter. It required arithmetic. If demand continued, inventory would fall. If inventory fell far enough, delivery would become uncertain. If delivery became uncertain, the paper price would lose authority. At that point, price discovery would move elsewhere. This was not a prediction. It was a sequence. Institutions understood this. That is why they moved first. Not because the system had failed, but because systems reveal their weaknesses long before they break. By the end of January, one conclusion had become unavoidable. Silver was no longer just a commodity priced by markets. It was becoming a constraint that markets would have to respect.